Good morning, everyone. I'm Brad Elliott, Senior Vice President with CAC Specialty. We appreciate our partnership with Intercom and the opportunity to moderate today's keynote panel. CAC is an employee-owned firm providing private capital and complex risk solutions for public and private companies and their sponsors. It's my pleasure today to introduce three outstanding midstream companies: Steel Reef Infrastructure Corp., Taproot Energy Partners, and Vaquero. Kicking off today's panel is Vaquero, a large-scale gas gathering and processing business that traverses the southern Delaware. Presenting for Vaquero is Bryant Patton, Chairman, Chief Financial Officer, and co-founding partner. Bryant has over 4 decades experience in the oil and gas industry. Bryant?
Brad, thanks very much for the introduction and moderating our panel. And I want to say thanks to all the Intercom guys, Aaron, Stu, and Michael, for getting this panel put together. And I certainly appreciate sharing the stage with Bill and Gary. You know, Intercom had us speak back at their conference in February in Dallas, which was about a month before the COVID hit us all really hard. Now, I've kind of found it hard to do jokes on a Zoom call, and because everybody's muted and you don't get any response, but I'm going to try to give a little story here. This whole scenario we've been dealing with the last few months reminds me of one of my dad's great sayings. He talked about bogus baseball, where you throw the ball and the batter hits you upside the head with the bat. Now, what game are we playing here? That's actually very funny in person, but we've all been there, and we're here again with the COVID's demand destruction and the subsequent free fall in oil and gas prices. And it's providing for very, very interesting times. I may be a bit redundant with some of my comments I had back in February, but as far as the Vaquero's history is concerned, there have been some changes. I will pass on some thoughts as to what we believe to be some significant change in how most, if not all, midstream providers in the Delaware Basin and maybe other basins have to function. That is, working within their own and producer cash flow, otherwise known as the new normal. This first slide with the picture shows our 2 plants that have been fully operational since June of 2018. The next slide has a map that expands our complete complex. Stu, if you'll change to slide 2 for me. It shows our entirety of our complex with 120 miles of large pipe, both 30 and 24 inch, running right through the heart of the southern Delaware Basin in Reeves, Loving, Ward, and Pecos counties, Texas. Our current capacity with our 200 million a day cryos also includes over 79,000 horsepower of compression. The rest of the slide, though kind of busy, shows the fact that we have 6 residue outlets and 4 NGL outlets at Waha, and that gives our producers and Vaquero significant optionality for these hydrocarbon products, which provides optimal netbacks and access to market liquidity. The next slide on page 3 shows more of the detail of our takeaway at the tailgate of our plant complex. You can see our 4 physical interconnects with NGL access to both Mount Bellevue and Corpus Christi. Also on the bottom right of the slide, you can see our 6 physical residue gas interconnects that gives us redundancy and reliability with access to the Gulf Coast, Mexico, North Texas, and the Midwest. The next slide, slide 4, shows a panoramic view of our existing plant site and the facilities that are currently housed there. But you can see the room on our 309-acre site to actually put in another 3 plants with plenty of room to spare, which gives us optional growth to a BCF a day of capacity. At the bottom of this slide, you can see our current producers that we are proud to be in business with. That includes Diamondback, EOG Resources, Cimarex, Oxy, and several other producers. The next slide depicts a little bit about how Vaquero evolved. My co-founder in Vaquero, Gary Conway, who really is the visionary behind the Vaquero system, has built 5 of these type of major midstream projects in his career. We first met when I was running an E&P company focused in South Texas called Camden Resources. And we had a need at Camden after making a major Wilcox discovery for significant amine treating. And Gary was putting in those types of systems with Crosstex Energy Services. Camden and Crosstex were both portfolio companies of Yorktown Energy Partners, who is our partner in Vaquero Midstream. Fast forward to 2009, and after the sale of Camden, I teamed up with two of the former founders of Crosstex, and we had started up TOGC Midstream. We brought in Gary Conway to build a 200 million a day cryo in the Eagleford with 110 miles of new large diameter pipe to our lead producer, which sounds very much like what we've done at Vaquero. And we had a very successful sale in May of 2013 of TOGC Midstream. Gary and I decided to do it again, and Gary's vision of Vaquero evolved. Though we were backed by NGP at TOGC, this time Gary and I teamed up again with Yorktown, for me, in August of 2014 to build this header and plant system in the Delaware Basin. We just had our 6th birthday last week, so we've been at this for 6 years, and I guess the good news is we're still here. The next slide shows our history of where we formed the partnership at $97 oil, saw the free fall in February 2016 at $26, commissioned the first plant in June of 16, did some significant planning and selling, honestly, to install our second plant by June of 18, and earned our way into significant volumes committed by Energen in June of 18. Energen then sold to Diamondback. From that point, we as a company had been adding volumes in a very accretive way right up until the COVID Saudi Arabia Russia collapse, which is the bottom right of this slide. We call that COSAR, standing for CO for COVID, SA for Saudi Arabia, and R for Russia. In fact, right at the time that the declaration of local disaster orders were being circulated all around Texas, our 400 million a day complex had its top day in our history of 370 million a day of throughput. That's over 90% capacity. Ordinarily, with the ramp that had happened and what we thought was coming from our existing producers, we probably would have begun building our third plant on our complex. However, with the month of COSAR we were dealing with, we had seen our volumes drop dramatically, obviously seeing producers cutting back on their drilling and certainly their completion activities. What we never dreamed of seeing was curtailment of PDP production, but boy, did we see it. So we started running our COSAR name sensitivities. I can tell you the next 4 months were not much fun, especially the first month. And candidly, it's still not a box of chocolates, but we've adapted to what we call the new normal. So if we go to slide change to page 7, this really shows in our specific area what has happened in the last 20 weeks to our rig count. Really unreal, a 78.5% decline in rigs running within 10 miles of our pipe and a 68.4% decline in the whole Permian. Very difficult. What's the good news? I guess in my 43-year career and through at least 7 price crashes, and though as I said, and I will reiterate, it hasn't been fun, our team at Vaquero has really stepped up. And I'm talking about everyone in our organization. Our exceptional plant operators, our field hands, our key operation managers, our ES&H people, our administrative staff led by our chief accounting officer and partner, Sandra Finley, all our business development guys, our gas supply, marketing, and scheduling folks, and everyone we're proud to call Vaqueros. We all went to work on doing everything we could to control and mitigate cash outlays while keeping operational safety and COVID avoidance high priorities. So going to page 8, it's a depiction of what, as I said in my intro, we think the new normal is. It's managing the net. That is, all the costs that get subtracted from whatever revenue we are receiving. As we all know, producers are almost uniformly talking about spending within their cash flow. Well, it's no different for midstream providers. We have the same problem. The only effective way to accomplish that is to manage the outflow of capital expenditure, operating cost, and G&A cost. Managing the gross revenue is always a challenge, but during these times, it's almost next to impossible in the current environment. Predicting revenues is highly volatile. We know about the hydrocarbon product prices. We know about the problems that producers are having not initiating their drilling plans and certainly not completing their DUCs. One thing a lot of people don't realize is this is a time where a lot of people are maintaining systems, and that's reducing a lot of volumes. The good news, as I get to page 9 in the next slide, is that our baseline production has recovered, but it's still very difficult for us to forecast growth. Just like predicting price, the weather, the stock market, it's very difficult to do right now. probably always is, but certainly now. So our Vaquero team has an ongoing process of managing the net. The real interesting thing right now is to see how new capital expenditures are going to be rationalized within the producer community. And I really don't know how that's going to pan out. You're going to have to stay tuned on all fronts on that. So getting to the end of my comments on the next slide, or this slide, I'm sorry, go back to the last slide. Here's what we're doing. We're trying to provide the Vaquero advantage to our producers. It's a producer-focused approach. We have the ability to scale our complex to handle any volume growth that may start coming up. Our operational reliability is fantastic, and we have financial stability. We are cash flow and net income positive, and we plan to stay that way, managing our net. The last slide is really just how you get a hold of us. The key folks are Gary and I are the co-founders, and we got a VP of Business Development. We look forward to hearing from any of you, and I really appreciate you listening, and I look forward to the questions.
Thank you, Bryant. Our next company is Taproot Energy Partners, the second partnership between management and Energy Spectrum. Taproot was formed in May of 2018 through a joint venture with Bison Oil and Gas. Taproot operates a crude and produced water gathering system in the DJ Basin with a focus on the Northeast Wattenberg extension in Weld County. Since its founding, Taproot has grown to 4 customers and over 220,000 of gross dedicated acres. Presenting for Taproot is Garrick Brown, with dual roles as Chief Commercial Officer and Chief Financial Officer. Garrick joined Taproot in 2018 and was previously the CFO for Coronado and Caliber Midstream. Garrick spent the first 15 years of his career in investment banking and private equity. Garrick?
Thank you, Brad, and thank you to Intercom. We appreciate the opportunity to get together with everyone here today virtually and share the Taproot story. You can hit to the next slide here. Our story is a little bit different than what you heard from Vaquero and Steel Reef. Ours is a younger business. Taproot was founded in 2018, and it's the second partnership between management and Energy Spectrum Capital out of Dallas. The first partnership, CoStar, was exited in 2014 through a sale to American Midstream. Taproot is led by Kevin Sullivan, who previously was the CEO of CoStar, and Rod Donovan, who was one of Kevin's partners at CoStar as well. Rod and Kevin both have 40 years of midstream experience with an emphasis on the gas side of the business. This next slide here shows all of the basins in which the team has operated, which you can see is pretty much every basin in the lower 48. We joke around that we took a team that had worked in every basin except the DJ and a team with extensive experience in gas, and then started a liquids gathering business in the DJ Basin. Next slide here. Here's an overview of what we've created thus far in the DJ Basin. Our specific focus is in the Northeast Wattenberg extension, where we gather crude oil and produced water for 3 producers. That's the northern part of the system you see on the map here. We call that the Baja system. We are also just now completing a transportation line that was built for Bonanza Creek that allows us to also have exposure to additional gathering opportunities in a different prolific area of the basin. Last, in our Baja area, we operate a freshwater system to support the completion activities of the operators in that area. Next slide here. This is the growth that we've experienced since our startup in May of 2018. Taproot was formed as a joint venture with Bison Oil and Gas, and our initial system was constructed to support its development activities in the Baja area. Subsequent growth in our system and customer base has been driven by proximity to our existing system, as well as transactions with a few of our midstream competitors and friends, to avoid putting redundant capital in the ground and focus instead on our respective service line offerings. Today, we have over 220,000 gross acres dedicated to our system. Next slide here. couple quick slides to tout the DJ Basin a bit. We feel like the DJ is often a bit overlooked because it is a smaller basin, certainly compared to the Permian and the Bakken. The DJ is very much an IRR-driven basin with somewhat more modest IPs and EURs than certainly what you might see in the Permian. The attractive economics in the DJ are driven by low and falling well costs, as well as ease and consistency of drilling and completion. Next slide here. A few charts here just to demonstrate how the DJ compares favorably to other key crude basins. I'd highlight here the chart in the upper left that demonstrates the drill days per well, as well as the chart here on the bottom right that shows the favorable drilling and completion costs on a per lateral foot basis here in the DJ. Next slide here. You can't really talk about oil and gas in Colorado without talking about the regulatory environment. For Taproot specifically, our system is located in a very rural area. You can see it here in the upper right corner of this map. And our system is entirely in Weld County, which is very supportive of the industry. As many of you know, the Colorado State Legislature passed SB 181 in April 2019, and that rulemaking process is ongoing. Fortunately, it appears that the governor is committed to allow that rulemaking process to play out instead of allowing additional referendum initiatives to meet the ballot. So for now, there appears to be a little bit of a truce that we hope will last while the rulemaking process associated with SB 181 is completed. Next slide here. We've obviously all gone through a very difficult period in the oil and gas industry, but we're excited about what a recovery in the economy and the commodity prices will bring to the DJ Basin. The recovery in the economy and activity levels and high IRRs will continue to attract capital and drive future activity and production growth. Upstream consolidation is changing many of the key traditional participants in the DJ through a number of transactions of which we're all aware, the most recent being the Chevron acquisition of Noble Energy. With the current infrastructure build cycle in the DJ nearing completion, we think we could start to see some consolidation in the midstream space as well. Thank you.
Thank you, Garrick. Our third panelist is Steel Reef, a privately held midstream company headquartered in Calgary with offices in Denver. Steel Reef provides infrastructure solutions to the best-in-class light oil in Saskatchewan and North Dakota, and plays an important role in reducing emissions, enhancing the well-being of its stakeholders, all while delivering excellent returns. Presenting for Steel Reef is Bill Champion, CFO. Bill has over 16 years of experience in oil and gas financial management, mergers and acquisitions, and energy banking. He was most recently Vice President of Finance and Treasurer for Meritage before joining Steel Reef a couple years ago. Bill?
Thank you, Brad, and the great team at Intercom. Steel Reef is very fortunate to have the opportunity to present here at Intercom's virtual conference in 2020. I'm excited to speak a little bit with you about the Steel Reef story and our disciplined approach to the current environment, as well as remaining positioned for growth as we look at the times ahead. This is our obligatory forward-looking statements disclosure. You can take there we go. Steel Reef is a privately held midstream company based out of Calgary. It was founded in 2012 by a group of industry veterans, including Lane McKay, Scott Southward, and Austin Voss, some of which came from other large midstream companies such as Keyera, and have extensive experience in the private equity background in Canada. I joined the team in April of 2019 and helped those founders open an office in Denver, Colorado, as the company found itself looking at growth into the United States south of the Saskatchewan border. The company is has equity support from a diverse group of private equity sponsors, institutional investors, and retail investors. Our largest being Instar AGF and PFM Capital. We have a diverse portfolio of high quality assets, sitting within the Western Canadian Sedimentary Basin and the Williston Basin in North Dakota. We remain focused on continuing to acquire and build out our system. Our thesis was really founded on the idea that many small infrastructure projects were being ignored by the midstream community in Canada, and the opportunity presented itself to create a small private midstream within the Canadian marketplace that could focus on producer needs and in the sub $50 million infrastructure space. Today we have a world-class customer base, including Tourmaline, Crescent Point Energy, Vermilion, Baytex, Tyne. These are some of the who's who of the Canadian E&P marketplace. And as we look forward, we continue to expand that counterparty base into new U.S. names as we do more work in North Dakota. You can take a flip here. In January of 2020, Steel Reef consummated a $500 million acquisition of infrastructure assets from Crescent Point Energy in Southeast Saskatchewan. That was underpinned by a 15-year take or pay with Crescent Point. Those take or pays also have operating cost pass-throughs, so it provides for a lot of stability in Steel Reef's cash flows. The acquisition added significant size and scale to Steel Reef, effectively doubling the size of the company. And in conjunction with that acquisition, we did recapitalize the company with another tranche, our sixth equity raise in the history of Steel Reef of equity, as well as a new bank syndicate with a $450 million senior credit facility. Today, the company is roughly $100 million EBITDA company. These are Canadian figures, and we have roughly a 3.5 leverage profile as we manage through the 2020 period. The assets, as can be seen on the map here, are largely centered in Southeast Saskatchewan, but we do have assets in Alberta and Southwest Saskatchewan and the Viking play as well. But our core is in Southeast Saskatchewan, and now it's starting to extend into North Dakota. We have 18 gas plants that are all interconnected, and we have the ability to move the molecule around on that system to provide for additional redundancy and reliability for our customers. Additionally, we have an extensive network of gas and oil pipelines and fractionation facilities that afford our producers additional egress and improved netbacks relative to some of our competitors. Our contract base is a bit unique. We are 85% supported by take-or-pay arrangements across that 100 million EBITDA, with a weighted average of roughly 9 years on those take-or-pays. Crescent Point, of course, being the largest after the acquisition at roughly 50% of our revenue for 2020. You can flip to the next page. Steel Reef, just to close the acquisition, as we headed into the late Q1 and ultimately the pandemic and the associated oil war began, but we felt we were very well positioned, for the cyclical downturn, as we had been for the 2014 and 2015 timeframe. Steel Reef continued to grow in those downturns and is continuing to grow in this one. We decided to focus on protecting our balance sheet, protecting our base business, and protecting our people and culture through this period of time. And I firmly believe that we've done that and demonstrated that with some of the measures that I've outlined here, Specifically, we pulled back on G&A to the tune of 30%. We've deferred some operating costs that benefit our producers in the pass-through structure, while focusing on continuing to provide producers optionality, be it to new markets or in terms of reliability of our system. As we look at what impacted our business during this period of time, we did see shut-ins in the field that in some cases were as high as 30%. However, the throughputs on the steel reef system only declined about 5%. The biggest reason for that being that the assets that were being shut in were largely assets that were off system or were non-core to the producers, and the assets that were on our system were very much core in the view of the producers. I think this speaks to the strength of the steel reef system and its importance to our customers and the services that we provide, and certainly has afforded us some additional financial flexibility as we've gone through this period of time. I'm proud to say that between my office and field performance, we've seen a greater than 98% reliability throughout 2020. Leverage profile has not meaningfully changed in any way. We continue to have very strong counterparties in the face of these challenging times, and we haven't had any delays on collection. We still see a very large deal pipeline ahead of us to the tune of $1.8 billion Canadian on both sides of the border, both north and south. And throughout this period of time, Steel Reef has continued to pay its quarterly dividend of 2.5 cents per share in 2020. So as we look forward, Steel Reef is starting to, like its producers, resume some long-term planning. Most of the producers are back at the table talking about what they're going to do in the 2020 and 2021 drill cycle, which largely occurs through the winter in southeast Saskatchewan before the breakup in the spring. Producers are focused on maintaining production and optimizing netbacks, as we approach the new year. Steel Reef is patiently sitting back and watching the macro and economic trends while assessing its capital projects and prioritizing those with the highest rate of return to benefit our shareholders. We also are preparing and seek out to have balance sheet optionality around strategic opportunities in the future, and hope that as the cycle comes back into favor, that there will be some further opportunities for Steel Reef to continue to execute on its longer term growth plans. With that, I would like to thank the team, for allowing me to speak to Steel Reef a little bit here today. Here is some contact information for Scott Southward, myself, as well as my team in the Treasury and Investor Relations departments. You can reach out to any of us and questions or for Steel Reef, and we look forward to the opportunity to chat with you about the Steel Reef story. Thank you.
Thank you, Bill. We have several questions for today's panel. All right, well, gentlemen, thank you for today's presentations. We've got several questions for the panel. Bill, let's start out with you. We're going to look at some financial macros. So what is the appetite today for private equity funding for both development projects and or mergers and acquisitions?
Thank you, Brad. Steel Reef was actually hard at work on its 7th common equity raise when the pandemic hit us back in March. As a result, we deferred that common equity raise. Fair to say that at the time, And to date, we've seen common equity raises be challenged as equity volatility remains high. I will say that I've seen a number of preferred options on my desk as well as in other areas of the market. So I believe that the preferred and the mezz market remains very, very much open today. And as we look at the future, we would hope that as equity volatility and ultimately commodity volatility subsides, that the common equity access to common equity capital markets would return in short order, which probably will be a major driver for M&A consolidation between third parties, as in many cases those types of opportunities will require some additional common equity to get consummated in the case where somebody is looking to avoid the high cost of preferred or mezz style capital.
Thank you, Bill. Garrick, what are your thoughts?
Yeah, I think our situation is a little different as we're a younger business that's still very much in our initial construction mode, and thus far all of our construction has been funded by equity capital and has been in support of our producer partners. Now, as it relates to new development projects as well as acquisitions, I think the bid-ask spread is still trying to figure out where things shake out in both of those areas. So, new dedications from producers, the terms are very different that I think are acceptable, from the providers of equity funding than they were maybe 18 or 24 months ago. And I think producers generally understand that, but there's still, I think it's a very fluid situation to figure out what that means as it relates to things like taker pays or NDCs or any of the other terms that are obviously very attractive from the equity funding perspective, but maybe are a little bit less palatable to the producers themselves.
Bryant, how about you?
I'd say we're probably somewhere in between both the other guys. We're private equity backed. We're doing everything out of cash flow. I will say that I think there's money out there. I think valuation is always the question as new money coming in to any structure. And it just seems to me there's just a ton of turmoil in the traditional private equity space. I got a lot of friends in that community. Unfortunately, I'm kind of long in the tooth, so I've been doing this a long time. And this is the first time I'm surprised that there hasn't been more of a contrarian type of capital coming into the business. You don't hear a lot of the people that have raised funds talking about being contrarian. They're all a little spooked by the ESG and the climate control and a lot of the issues that the institutional LPs are raising. It's a time of turmoil for the private equity guys, but I think solid projects always have a home. There's no panacea in raising capital. You have to have great project, great management, and you have to have great returns. But it's an interesting capital market from my perspective.
Yeah, thank you. And Bryant, we'll stay with you for the next one. So what are your expectations for bank finance for the rest of the year? And are these expectations shifting? And if so, how?
Well, that's another area that's very interesting to me. The upstream guys are really struggling. There's a lot of companies that are going through the redetermination processes starting here right now. And I'm hearing some pretty awful metrics coming out of the upstream bankers. I think that's going to impact the availability of credit in the midstream space. I think a commodity price increase would help all of that. But I think it's a very, very difficult market on the commercial side as well as on the equity side.
Thank you. Garrick, how about you?
It's interesting. So we're currently in the market for our first credit facility. As I mentioned before, we've been equity funded thus far. And we are actually at the point now where, due to some pads coming online in our area, we're now an EBITDA positive business and have the highest volumes we've had to date coming through our system. And so as we've been out talking to banks, there are a number of institutions who, depending on how strong the relationship you have with the individual, will tell you pretty candidly, hey, look, we're just not open for business on new loans because of what's going on in our existing portfolios. There are also some others where it feels like you barely kind of get the story out, get the introduction of the opportunity out, and they're kind of telling you, look, you know, here's a problem. We're not interested. So obviously a very, very difficult bank market. But I have found through this process that there are some institutions that have weathered the downturn fairly well, mostly due to the books that they had, their own portfolios kind of coming into the downturn. And some of those institutions, I think, are looking to be a little bit contrarian. And I'm reminded somewhat often that I had an old boss who used to say, you know, you can't play with scared money. And I do think that in, you know, my own experience, when capital is the most difficult to obtain, oftentimes you look back on it and it's the best time to have gone through the pain of obtaining it. So I'm optimistic that will come true here in this credit facility process, but it's certainly not, to build on the comment that was made earlier, it's not a box of chocolates by any means.
Absolutely. Bill, what are your thoughts?
Yeah, Steel Reef had the good fortune of putting a credit facility in place, you know, just before all this occurred. You know, what I would say is I don't feel like that everybody's an equal in today's environment. And as an ex-banker, you're going to really lean on the counterparty strength and the strength of contracts of a given company. I feel that we continue to have strong access to bank capital markets at Steel Reef, albeit if I were required to reopen my credit facility today, it would probably come at a cost of an increased cost of funds of 1 to 200 basis points. So we are living within cash flow. We're staying within our covenants, as we go through this environment and remain disciplined in order to, again, provide for more optionality on a go-forward basis. But certainly, the type of company and the type of counterparty and the type of contract mix that you have make a big difference in an environment like we're in today.
Sure. Gary, how about you take this one first? So to what extent are alternative sources of capital kind of filling the gap between the private equity and bank finance?
You know, here's an area where I would contrast this downturn with what we experienced in 2014, 15, and 16. So in that era, I feel as if we got a number of inbound calls and requests for meetings from alternative capital sources who might be looking for a little higher yield in return for kind of patching up the capital structure. And thus far, we have not seen those entrants or not experienced those inbounds. And I don't know whether that is a function of what we've experienced with COVID, that people are just not out calling on potential relationships as actively as they were previously, or whether it is a little bit of a function of the surprise that I think Brian mentioned earlier, that people aren't being a little bit more contrarian. So it'll be interesting to see how this plays out as the market stabilizes a little bit, which I feel as if it has, and then ultimately, I think we all hope will improve with the return of demand. And so, I think the short answer for been a little long-winded. Thus far, haven't seen it, but would anticipate that coming here in the next 6 months or so.
Yeah. Bryant, what are your thoughts?
In the 90s, I was a lender for college endowment money to the energy industry, and we got current yield of 20% for PDP backing of producers. And I see the turns that have been going on in our business for a long time now, and you're starting to see it creep back up. I think it's the gap is not being filled just yet, and I think the capital that's going to come in to fill that is going to be significantly higher as a cost, probably 7 to 15%. I've got a friend who just opened up kind of a capital advisory extension of the Ten Oaks folks. His name's Chris Pareda, and he's been really kind of scouring the the markets out there. And he says there are some non-bank alternatives, and some are PE backed, which is kind of interesting. And they're structuring deals kind of like we did in the 90s, where you get, current yield on a coupon, and then you get some other piece of the upside. And I hope it doesn't go back to that, because I did that for 8 or 9 years. I think it's a horrible capital structure, because it doesn't give enough capital to the borrower to be able to manage his business. But it's a very interesting time to see if that's going to start be what capital evolves into our business.
Thank you. Bill, how about you?
Yeah, I would echo some of Brant's comments there. As traditional lending continues to pull back through what has been now multiple cycles over the last decade, it is creating more opportunities for alternative forms of capital, but at a much higher cost, which is ultimately just increasing the weighted average cost of capital of energy firms across the board to the tune of 2 to 5%. When we think about our hurdle rates internally, that will mean that we all have to be a little bit more profit focused, a little more return focused as we move forward, probably at the cost of a reduced growth rate. But I don't see lending becoming aggressive in the energy space again. Certainly the box, if there is one, is something that those lenders are very much going to stay within, and those alternative forms of capital will replace the creative lending practices that we've seen here in the last 5 or 7 years from the banks. So I continue to expect more conversion there, but again at a higher cost of capital back to the energy space.
You bet. Brian, how about you take this one next? So in light of this year's drilling cutbacks, to what extent do you believe concerns about takeaway overcapacity are well-founded?
It seems to me there's always been an overbuilt nature of capacity. It'll be interesting to me to see how many projects that have kind of been announced but actually haven't been started get started with the mantra that everybody's trying to live within cash flow. Seeing people build projects without the firm commitments. I'm really impressed by Bill's company and how they get all these take or pays, because that's not been the market in the domestic midstream. Certainly in the Delaware Basin, there was a lot of money being spent way ahead of volumes, and I think there's some excess capacity right now, but will it be there if there's not any new capacity built with the obvious development that should take place over the next 2 or 3 years? So I think the midstream space has always been a little bit overbuilt in the areas that I've looked at.
Thank you. Garrick?
Yeah, I kind of split that question in my mind into the in-basin capacity and then what you see on the long-haul pipes. And so, in-basin, in the DJ, certainly I think you see a little bit of overcapacity here today as production levels have come off. And I think in the long-haul space, as an in-basin gatherer, in some ways, the more capacity, the better, because that creates a competitive situation for rates to get from the DJ down, down to Cushing, which obviously helps the netbacks for our producers. I think that in the DJ specifically, it'll be interesting to see where pricing to get from the DJ down to Cushing kind of settles through this, through this cycle, and how that impacts, our producers. The other thing I've thought about, or been, obviously we've all been reading about a little bit, is what is the likelihood that future long haul pipes are built in this country, and what does that process look like? Are we now looking at, you can put a plan together to build a future pipe, but it's going to take you 5 or 6 years to get through the approval process, or will that area of the market settle down a little bit as well? I think it's going to be interesting to see how that plays out.
You bet. Bill, what do you think?
Yeah, look, I think I again resonate both of these comments, but overbuilt capacity provides for additional producer optionality as far as egress. We compete with our downstream egress solutions in the form of home built fractionation and quite frankly, a more competitive netback to our producers than some of these downstream projects ever are afforded. And when I spoke to my marketing team about this, they were concerned that as these large regulated pipelines became underutilized, that there would innately be increases in cost of service if production profiles didn't come back. So there could be a long-term impact that long-haul pipelines see an increased cost to move the product around, which should bolster other forms of egress, be it local market distribution or perhaps exploring alternatives to the incumbents. Steel Reef, is actually pushing natural gas and natural gas liquids out of North Dakota up into Canada as an example, because we can provide better netbacks to our customers in North Dakota, in the Canadian marketplace than what they're afforded, from the incumbents and that marketplace. So I think it spells out opportunity, Brad, but it also casts a bit of an ambiguity around what the future will hold.
Yeah, thanks, Bill. Brian, how about you take this one next? So the pandemic has obviously reduced financial flexibility and led to higher debt levels for a lot of companies. However, we all expect economic growth to happen. So as it does, what are the likely implications for capital management?
I think I talked about that in my words, in my comments, that we have focused almost entirely on managing the net. Now that we're through that unfun phase, I think I'm perversely optimistic that there are things that will make a lot of sense, but I think we're on the same page as the producer, that we're going to do things within cash flow. It's hard to predict growth, but certainly when we visit with our producers, they're going to have a game plan, and we have the ability to really pivot and put more volume capacity in place fairly cost effectively. But rather than getting out ahead of our skis in any way, shape, or form, I think it's going to be a collaborative effort with the producers.
Yeah, you bet. Bill, let's go.
We've really focused in on returns on investment for the last 120 days. We've reprioritized our entire deal pipeline to focus on those that have the highest and greatest returns for our shareholders over the foreseeable future, and of course carry a risk that is acceptable in today's market. We are continuing to launch on new capital projects with our counterparties, and I think as we look forward, we do want to preserve some optionality on the balance sheet to once again become acquisitive when the time is right. But for the time being, that probably looks more like a bit of a deleveraging than anything else on the balance sheet.
Okay, Garrick.
Yeah, one thing I'd echo in Brian's comments as it relates to producer collaboration. I've noticed since the downturn has occurred that we're having what I would describe as a little bit more kind of constructive, forthright conversations with producers around, managing our capital exposure as they're developing new areas. And so, in some ways, you always want to be an optimist in these situations, and that's a change that I think we've seen that we hope continues as you come out of the downturn, that you can continue to have conversations that allow us to stage our capital investment, as producers are going out and putting 8 wells on a pad and really developing certain areas of their acreage.
Absolutely. All right, Garrick, I'll stick with you for the next one. So how are you thinking about, in the short term, the balance between CapEx, M&A activity, and potential shareholder distributions?
Yeah, here's where we have a benefit of being a young business, because we're not yet in the situation where distributions are in the equation, so you get to remove a variable for us. But, we are certainly continuing to look opportunistically at acquisitions that that might arise in our area. And I mentioned previously, we've done a couple deals with other midstream providers just to make sure we're not putting redundant capital in the ground, and that I think has benefited all of us collectively. So as we move into what I think is sort of inning 7, 8, maybe even 9 in this CapEx build out cycle within the DJ, we are still very much in construction mode, but I think for our base system is in place, and so from here on out, we're looking at maybe smaller projects for well connects and things like that. So one of our key areas of focus is let's figure out how consolidation plays out. So remain open to M&A opportunities and acquisition opportunities, but also be thoughtful about doing some things to try to lower our cost of capital as we complete the build out of our system.
That's good. Bill?
Steel Reef's a bit unique in this department. We've paid a dividend since 2014, and we've grown it actually every year during that period of time. We continue to pay our dividend today. We believe that dividend provides for a strong floor to our share price, and ultimately affords us better access to common equity capital markets as we approach those markets. And talking to our investors, which are a diverse group of retail and institutionals, they all see value in that distribution, be it at a lower payout ratio as we move forward and we continue to grow. I think we'll place less priority on that dividend and more so on growth projects as we focus in on high return projects with low execution risk. And as it pertains to M&A, I think we'll find optionality in the M&A market, either through deleveraging, as I said before, or in the resumption of normal common equity markets coming back into favor and allowing for further consolidation within the basin.
Okay. Bryant?
We're maintaining a very disciplined approach to our future CapEx spends. We have to have a real clear view of profitable return on investment before we really engage in some of the new build outs that we may have contemplated 6 to 8 months ago. We're being very, very stringent on our capital spend. And while we could be paying distributions, given that we're still living in a COVID low oil price kind of environment, I think Bill said something about $50 being something we'd all like to see to get a little more comfort. You go out with the strip and it's not getting there very soon. We've elected to kind of build cash for the remainder of this year, and we'll reevaluate capital return to our shareholders. We've got great partners that like the asset where we are, what we're doing out there, but I'm still not overly optimistic about price, but I could change my view if you start seeing some of the demand come back, and that gets into all other kinds of discussion, but that's kind of where we are on things.
Okay, thank you. All right, Bill, how about you take this one? So as we look out further, so let's take a medium to long-term view. How should we be thinking about your corporate strategy, and does that include M&A activity?
Yeah, we've been hard at work at redeveloping our 5-year strategic plan here for the last 90 days or so. We felt like we got to a place at the end of June where we could start to do some long-range planning again as commodity prices came up and ultimately found some footing above $40 crude. I do believe that before we see aggressive growth, we do need to see something that looks like $50 a barrel crude. But for us, our strategy really hasn't changed. Some timing has changed, and perhaps access to capital markets has changed. And so as a result, we're not assuming any kind of capital raises in our plan, today. That doesn't mean that we wouldn't go and consider it or look to do more of it. But I think we would look to go and try to find, acquisitions, perhaps even on a financing contingent basis. Whereas before, we were kind of out there asking for equity, and we'll go get the acquisitions later. Today, there's no reason to to get too aggressive on the M&A market until you know where you're going to get your money from. And if the money remains in the position that it's in, then we're probably going to continue to be disciplined and patient. So I would say from a medium to long-term perspective, we've just seen our growth assumptions come down a little bit while we focus on profitability and returns.
Okay. Gary, how should we be thinking about Taproot?
Yeah, I think very much a time to be focused on capital discipline. And we want to make sure that we are able to participate in the processes for the remaining kind of outstanding crude dedications in the basin that appear to be attractive. And that's sort of called a short to intermediate term goal. So I think by the time you get 18 to 24 months out, a lot of that remaining attractive acreage is somewhat spoken for. And then as you move forward, a lot of what we're going to be focusing on is how do we maintain our operational focus, make sure that we're very focused on SG&A and operating expenses, and participate in what I think, at least logically, you'd expect to be some sort of a consolidation in the basin. As the capex need reduces and the cash flow starts to come off of a number of midstream businesses, ours included. I think that's a natural time for some sort of consolidation to occur, especially if you get, back to call it $50, $55 crude.
Bryant?
I can kind of see why my wife thinks I'm not a lot of fun to be around these days, because it's kind of a broken record for how I'd answer this question. And, we're going to live within cash flow. We're going to have a strong focus on our expense management and maintain a strong balance sheet. So if there is opportunity for investment, we can pounce on it. We're going to maximize the shareholder returns. I said it a little bit before. We have the ability to escalate our capacity in a very cost-efficient way, but I think rather than just seeing an improvement in commodity prices, we got to see a little bit more corresponding commitments from producers to really get out there and spend the kind of money that it takes to build that capacity, additional capacity.
Yeah, thank you. All right, gentlemen, here's our last question. Gary, how about you take this one? So, given the situation, what have you been doing to provide safe and reliable operations during the COVID-19? And then kind of what are the ongoing impacts that the pandemic has on your company?
Yeah, this is one of those areas where we're all really learning on the fly. And I think, we here in Denver, the local government, kind of made the rules for us a little bit initially with some of the shelter in place recommendations. And so as a company, we were all working from home, and then we started to come back in June, and we did that somewhat selectively. So, the mantra to our employees is, we spend 3 days in the office, 2 days out, but if you feel, at all kind of not yourself, don't come in. And so we take temperatures every day. We ask about symptoms every day. We do the things to try to make sure that our employees are staying healthy. And in addition to that, we also, recommend, obviously, make the comments to our employees: be careful on the weekend, be careful when you're not in the office about your exposure to others who might be infected. We rely a lot, I think, on having good employees and general common sense provisions about, carrying these masks everywhere we go in the office and wearing them in the common areas. And thus far, it's worked well for us. The longer term impacts, you think about it a little bit here in downtown Denver, because you used to just run up and down 17th and go see all your producers. And I kind of wonder, are we ever really going to return there within the next couple of years, absent any vaccine availability? And, it's a very different environment here. And I think that's obviously not that profound of a statement, but the way that business used to be done in the oil and gas space in Denver, very different today. It's a different era, and I miss the old lunches and things like that, and I hope we'll get back there, sooner rather than later. But thus far, our method of of keeping people safe, both in the office and out in the field, has worked. And so we're hopeful that will continue here going forward.
You bet. Brian, how are things in Texas?
Hot. But when the COVID hit, we didn't know exactly what to do. We told everybody to stay home. We were very fortunate in our Dallas office. We just moved into this space. So it was brand new build out. There weren't a lot of people in the building. So as we had people wanting to come back and work in the office, it was easy to have a lot of spacing because we have a lot of square footage, and that was pretty good. In the field, we're very fortunate to have a regulatory and EHS director on staff, and she's been very, very helpful with getting all the information to our field guys to do their work in compliance with all the protocols that have been set out. So we're fortunate we haven't had anybody come up testing positive. Those that don't feel right, we tell them to please get tested. And I'm not sure what the environment has to go forward. All I know is I had to get tested at the demand of my daughter-in-law so that I could see my grandson. So I've actually gone through the test, tested negative. It's not fun, but it's amazing what will motivate you. It'll be interesting to see when she goes back to teaching school here in a couple of 3 weeks, I guess, what that's going to be like. But it's a very, very strange time, obviously.
You bet. Bill, what are you and Still Reef doing?
We have over 160 employees today. So this was something we've spent a lot of time talking about from a business continuity perspective. I was on one of the last flights out of Calgary back to home in Denver before they closed the border in March, after being on a roadshow all of February. We immediately shut the office, and just recently we reopened our Calgary and Denver offices on a voluntary basis. We're allowing for up to 50% of the staff to come in, at a given time. And the field, we made big adjustments to make sure that supervisors and operations managers weren't moving across all the various assets and potentially exposing more field personnel than necessary. And so we've isolated the operations of those assets to the specific teams, and by virtue of that, kind of separated and the risk of cross-pollination, if you will, or cross-contamination. That has been a successful process. North Dakota and Saskatchewan are by the virtue of where they are very socially distant. So we haven't seen any kind of cases across our employees to date, and we're very fortunate and thankful for that as we continue to protect our people through this very difficult time.
Yeah. Well, gentlemen, I'd like to thank you for today's presentations, this very engaging discussion, and being part of the 25th anniversary of the Oil and Gas Conference. I appreciate it. Thank you.
Thank you, Brad.
Thank you.